Okay, Chapter 16, Dilutive Securities and Earnings per Share. So for this chapter, I want you to just briefly focus on some main important topics. For those others, you read it by yourself. So dilutive securities, we have some, for example, debt bonds can be converted to stocks, or we have preferred stocks can be converted to common stocks. So how to record those? Like on page 4, at the time of issuing, at time of conversion, and induced conversion. So like this one, convertible bonds. When we convert, uh, the debit bonds payable, debit, this is a premium case, unamortized premium, and then common stock, and then paid-in capital in excess of par common stock. Okay, if we have induced conversions, generally induced means you pay extra. So here the business has to pay more, like a credit cash. Okay, about convertible preferred stocks, very similar. So like this one, we have convertible preferred stocks on the debit side, paid-in capital in excess of par preferred stocks, and credit is common stock. And if we have anything else, that would be reduced return earnings. So it will like here return earnings to record the 800 the differences. Okay, and then let's see. That's the first part. Second part, stock warrants. Stock warrants is issued with other securities. So there are two methods to calculate it. One is a proportional method, like what we learned before in the lump sum. Another one is incremental. They are not difficult. So like the first one, proportionate, proportional method is to allocate based on their fair value and multiply the percentage. And the incremental method is to have a lump sum receipt, and then some of those we know allocated to warrants, and the rest of those allocate to bonds. Okay, not difficult. Okay, and then stock compensation plans. The first couple pages focusing on those forms, give you the examples about what stock compensation plans look like, and then about how to record recognition of the stock compensation on page 13. And the best way is to use the example. So we have to determine expense, allocate compensation expense, and the stock compensation example here is on page 14. So at date of the grant, we do not have to record. And when we record the compensation expense for the 2020, we know that it will be allocated in 2 years, so 1/2 of the 220,000. So debit compensation expense, credit paid-in capital stock options. And we do that for next also for the year next year. So the total is 220. And then if uh, the CEO somebody exercise it, we got collected cash from that employee, from that manager, and we have the paid-in capital stock options we recorded before. Okay, and then we that's issuing stocks and the paid-in capital in excess of par. What if it is expired? For example, like here, uh, it just exercise 20%. That means 80% expired. So for the paid-in capital stock options, 80% of the 220 will be expired, decrease the paid-in capital stock options that T account to 0. And then paid-in capital expired stock options on the credit side. That's how to record. Restricted stocks. Restricted stocks, that's generally about if it's a restriction, it restricted stocks never becomes completely worthless. And it's less dilution to existing stockholders and aligns the employee incentives with the company's incentives. So restricted stocks, let's take a look at the example on page 15. and makes the following entry on the grant date. So we have the unearned compensation. Credit common stock of credit paid in capital in excess of par of common stocks. So unearned compensation represents the cost of services yet to be performed, which is not an asset. It's a not asset, unearned compensation. And at the end of the year, this records compensation expense of 4,000 as follows. So debit compensation expense, credit unearned compensation. We recorded before part of those. So that's the restricted stock examples. And then next page, if the person leaves on February the 3rd, and then before an expense has been recorded, the entry to record this forfeiture is as follows. So those stocks, we do not have to give it to the employee anymore. So debit common stock, debit paid in capital in excess of par. And then compensation expense, we still have quite some of those, another 4,000 multiply 2 years, and then unearned compensation for the rest of the for those unearned compensation 20,000. We have this one already recorded, and then another one. So okay, so that's for this case. And then employee stock purchase plans disclosure, you read it by yourself. Okay, that's the first part of the diluted, kind of like a dilutive securities.